Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming-soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.
Disclaimer from the always present legal team. Podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.
Okay, so you're looking for an edge in finance, right? Want to know what's got serious investors talking?
Mm-hmm.
Well, today we're going deep on lower middle market direct lending.
Okay.
You know, it's been generating a lot of buzz. We're going to try to cut through all that, bring you right to the key insights. We've been digging into some great stuff from P&I Custom Content, and they've got this fascinating interview with Rich Christensen. You might know him, senior partner over at TPG Twin Brook Capital Partners.
Oh, yeah, I've heard of him.
Yeah, he's a big name. So what we're going to try to do is figure out what's got all these institutional investors so excited about this corner of the market.
Yeah, what is it about the lower middle market that has them so interested?
Right. And especially when you look at the potential. I mean, we're talking about potentially attractive returns, of course, but also lower leverage, which is always nice, and the possibility of getting that nice, consistent income stream.
Consistent income is always attractive.
It definitely is. So let's just dive right in. Private credit itself has become a big deal in the past couple of years.
Yeah, no doubt private credit is having a moment, for sure.
But what P&I really highlights is that it's this specific part of the market, the lower middle market, where things are really heating up.
I see. So within private credit, it's that lower middle market that's really getting all of the attention.
Exactly. And it seems like the driving force behind this attention are some fundamental characteristics that make it very appealing to sophisticated investors.
Interesting. So it's not just a fad. There are solid reasons why it's attracting investors.
Right. And you hit on one of the big ones right at the start. Attractive returns.
Of course, returns are always important.
Always. But the interesting thing that P&I points out with Christensen is that, in the lower middle market, you often see those returns being generated with, like I was saying before, lower leverage compared to the upper middle market.
So it's not just about the size of the return, it's how those returns are actually being generated with less risk.
Yeah, exactly. And, less debt in the equation means you've got a bigger cushion if things go wrong.
Makes sense. It's like having that safety net.
Right. And that's what makes the risk-return profile so attractive to these big investors, especially right now.
Right. Because it's not always just about the potential gains. It's also about protecting against potential losses.
Exactly. And on top of that, it's also about the kind of income you can expect. Simpler debt structures and tighter financial covenants. Those can be a real advantage here.
Okay, now hold on for a second. For someone who's not totally immersed in this world, simpler debt structures, tighter financial covenants, what does that actually mean for their investment? How does it affect their bottom line?
Well, think of it this way. Simpler debt structures mean fewer moving parts, basically. So instead of dealing with all these different layers of loans with their own complicated rules and priorities, you often have a more straightforward primary loan, which makes things much cleaner.
Got it. So less complexity, less potential for things to get tangled up.
Exactly. And those tighter financial covenants, those are like built-in safeguards, right? Early warning systems. They set specific financial goals for the borrower. And if the borrower doesn't hit those goals, then boom, red flag goes up. Gives the lender more options.
Oh, I see. It's like having those checks and balances in place.
Exactly.
Yeah.
And this is something Christensen really emphasized in that P&I piece. He's seeing more attractive returns, but he's also seeing this lower leverage and stronger lender protection, which is a really powerful combination when you compare it to the upper middle market.
That makes a lot of sense. And you know what else he mentioned in that article?
What's that?
Well, he was talking about how the current competitive landscape in the lower middle market, it's actually working in favor of lenders because it can lead to this pricing premium.
Oh, that's interesting. So it's a good time to be a lender in this space.
It seems so. And all of this adds up to the improved risk-return profile that we were talking about.
Now, we always have to look at the bigger picture, and the current market outlook is actually looking pretty good, according to P&I. and we saw a bit of a slowdown in deal volume in 2023, but 2024 saw a nice rebound, and the expectation is that's going to keep going into 2025.
So things are picking up steam again. That's great news for investors who are looking to get into the lower middle market.
Right, because more deals mean more opportunities to put their money to work and hopefully see those returns we've been talking about.
Yeah, it's all about finding those good investment opportunities. And Christensen, in the P&I piece, he noted that they saw a broad recovery in deal volume throughout 2024. And they're predicting that M&A activity, which, as you know, often drives direct lending, it's going to stay strong, maybe even grow in 2025.
That's great to hear. More M&A usually translates into a more active direct lending market, so that's good news.
It definitely is.
But of course, it's not all sunshine and roses. We're living in a very dynamic economic environment. Things are changing all the time.
Yeah, there's always something, right?
Always. And that means there are always potential headwinds. We've got to think about economic growth, inflation, interest rates, geopolitical events, all these factors that can create a lot of uncertainty. P&I really emphasized how important it is to navigate these challenges, especially in the direct lending market.
It makes you realize how crucial experience is when you're dealing with all these interconnected economic forces.
It really does. And Christensen made a really good point in that P&I piece. He said, if you really want to evaluate credit opportunities effectively, you have to understand the underlying economic conditions and all the different disruptions we've seen over the past few years. I mean, think about what we've gone through. A global pandemic, supply chain issues, inflation spikes, interest rate hikes.
Yeah, it's been a wild ride for sure.
It has. And Christensen stresses that to lend successfully through these cycles, you need a robust investment process and a disciplined approach to credit. You can't just ignore these uncertainties. You have to know how to assess them and manage them.
It's about having the expertise to navigate those choppy waters.
Exactly. And, it's really interesting to see how the lower middle market has performed in the face of all these challenges. Because according to P&I, it's shown remarkable resilience, especially considering what we went through with the pandemic and then the inflation and interest rate roller coaster.
It is surprising, isn't it? You'd think that smaller businesses would be more vulnerable to these kinds of economic shocks, but P&I suggests that's not necessarily the case.
Yeah, and what Christensen pointed out in the P&I piece was how effective these lower middle market companies have been at managing things like supply chain disruptions, labor shortages, and the inflationary pressures. It really speaks to their adaptability and operational agility.
Yeah, it shows they can pivot and adjust when they need to.
They definitely can. And that actually brings us to another key takeaway from the P&I feature, the perception of risk. A lot of investors might think that lending to smaller companies is automatically riskier. But when you look closer at the lower middle market, it's a bit more nuanced than that.
It's not as simple as just assuming that smaller equals riskier.
Exactly. And that's where Christensen's perspective in the P&I piece is really valuable. He talks about how in the lower middle market, you often see these more conservative debt structures, smaller lender groups that are really focused, and a strong emphasis on investor protections. And all of that can actually create a better risk profile for lenders compared to some of those bigger deals in the upper middle market.
So the structure of the deals themselves, the dynamics of who's involved, that all plays a crucial role in shaping the risk.
It really does. It's not just about broad market trends. It's about understanding the details of each lending situation. And that actually highlights something else. P&I talks about the importance of education. Managers need to be able to clearly explain these enhanced lender protections and the attractive return profiles to investors, especially those who might be more familiar with the upper middle market.
Right, because if investors don't fully understand how the lower middle market works, they might hesitate to invest, even if the potential is there.
Exactly. Investors need to have confidence in how risk is being managed and what kind of rewards they can expect. And in that P&I piece, Christensen talks about how important it is to have detailed discussions with investors, really break things down, clarify how credit risk is managed, and highlight the specific lender protections that are in place, which can be quite different from what you see in those larger deals.
It's about transparency and education, helping investors see the full picture.
Right. And as more investors become familiar with these dynamics and start to see those attractive credit return profiles, they're more likely to consider allocating capital to the lower middle market.
And those attractive credit return profiles, that's what leads us to the potential for those superior risk-adjusted returns and recovery rates, right? Compared to the upper middle market, I mean.
Yeah, that's really at the heart of the investment case for the lower middle market. All those factors we've been talking about, lower leverage, simpler debt structures, stronger lender protections, they all work together to potentially increase recovery rates if a borrower runs into trouble. And P&I cites historical data to support this, showing higher recovery rates in the lower middle market, even when you look at periods before and after major events like the pandemic.
Higher recovery rates, even compared to larger companies, that's a big deal.
It really is. But understanding the potential returns and the risks, that's just one piece of the puzzle. P&I also highlights how crucial the manager's skills are in sourcing deals and managing the overall investment process.
Absolutely. It's one thing to know the market. It's another to know how to operate effectively within that market.
Exactly. Christensen really emphasized that in the P&I piece. He said that managers need to be able to clearly show how they're managing credit risk with these lower middle market borrowers. That's what makes the case for this strategy compared to others. Investors need to look at the manager's network, their relationships with borrowers, their portfolio construction approach, how they handle the specifics of lending in this market. All those things help paint a clear picture of the risk profile.
So it's not just about the numbers, it's about the human element too, the manager's expertise and experience.
Exactly. And, P&I also pointed out something that goes hand in hand with all of that, the importance of deal flow. Managers need to have both the scale and the origination capabilities to keep a steady stream of good opportunities coming in.
Scale is great, but it's useless if you don't have the deals to put that capital to work.
Right. And in the P&I interview, Christensen was adamant about maintaining that strong deal flow. He said it's absolutely crucial for managing risk, making sure you've got a diversified portfolio, and hitting those higher return targets we've been talking about.
So it all comes down to having that consistent access to quality deals. If you don't have that, you can't really take advantage of the potential of this market.
Exactly. And looking ahead, it seems like the outlook for the lower middle market is positive, especially if we see M&A activity keep climbing, which P&I suggests is likely. They talk about the opportunities that come with investor exits and refinancing activity.
So more potential for growth and continued momentum in this sector.
It seems so.
Yeah.
If M&A activity stays strong, that'll create new lending opportunities as investors look to exit their current positions and put that money to work in new deals.
It's a cycle of opportunity.
Right, and refinancing is also expected to keep driving deal volume in the lower middle market.
So a lot of factors supporting continued activity.
Yeah, and Christensen, in that P&I piece, he predicted that we'll see an increase in sponsors exiting their portfolio investments in 2025. And he thinks that's partly because of those economic and market disruptions we talked about, how they extended investment timelines.
Mm-hmm. So private equity firms are looking to capitalize on the more favorable market conditions.
Exactly. And P&I wrapped things up by saying that overall, there's a lot of optimism that the positive trends we saw in the latter part of 2024 will continue into 2025.
That's encouraging to hear.
It is. So, taking all this together, what we've learned from P&I and from Rich Christensen, it really makes a strong case for lower middle market direct lending. It's an area that's becoming increasingly attractive for institutional investors. We're seeing the potential for good returns, but the key takeaway here is that the risk profile might be more appealing than many people think, thanks to things like lower leverage and stronger lender protections.
It's all about those factors that help mitigate risk and enhance the potential for positive returns.
Absolutely. And, P&I really highlighted the importance of having experienced, disciplined managers in this space. Because while there will always be economic uncertainties, it's those managers who can navigate those challenges and really unlock the potential of this market.
Experience and a steady hand at the helm, that's what makes the difference.
Absolutely. So as you think about all this, what are the key things you'd focus on if you were evaluating a potential investment in lower middle market direct lending? How do those specific characteristics we talked about, lower leverage, stronger lender protections, fit into your overall assessment of risk and return? And what other questions do you have now based on what we've learned from P&I, especially when it comes to choosing the right manager and doing your due diligence in this constantly evolving world of lower middle market direct lending? Really gives you a lot to consider. Thanks for joining us for this deep dive.
Thanks for having me.
Thinking of exiting your business or taking on a private equity partner to help you grow faster? BizNexus has you covered. Tap into our network of thousands of best-fit investors, acquirers, and proven M&A advisors, and we'll help you begin the relationship confidentially on your terms, your timeline. Learn more at biznexus.com.
Disclaimer from the always present legal team. Podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.